September 12, 2008, Lehman Brothers holds $639 billion in assets. 48 hours later, it is the largest bankruptcy in American history. Not a hostile takeover, not a fraud indictment, just gone in a single weekend. 25,000 employees walked into their Manhattan tower on a Friday. By Monday, security guards were handing out cardboard boxes. This was a firm that survived the Civil War, 2 World Wars, and the Great Depression. 5 and 8 years old, and it collapsed in less time than it takes to close on a house. Wall Street had a name for firms this large, too big to fail. Lehman had survived the panic of 1907. It did not survive September of 2008. Here is the number that should terrify you. At its peak, Lehman stock traded near 86 a share. By the following week, it was worth pennies. Every major bank on Wall Street watched the same crisis coming. Bear Stearns nearly collapsed just 6 months earlier. Lehman saw the warning and did the opposite of retreat. While rivals cut their exposure to toxic mortgages, Lehman increased it. The firm that should have run from the fire ran toward it. That single decision is the question historians still argue over. Not why the crisis happened. Everyone knows that. But why Lehman, alone among giants, bet everything it was too smart to lose. To understand how, you have to go back to the beginning. Back to a firm built on 158 years of surviving every crisis but this one. It began in a dry goods store in Montgomery, Alabama in 1850. 3 immigrant brothers, Henry, Emmanuel, and Mayor Lehman, sold buttons and thread, then started taking cotton as payment. That cotton shed became a trading desk. By 1858, the Lehmans had moved their headquarters to Wall Street itself. The firm survived the Civil War, the Panic of 1907, and the Great Depression, when 90% of Wall Street firms didn't. In 1929, while other banks burned, Lehman helped invent venture capital, backing the era's boldest new companies. For 58 years, it survived by staying cautious. Then in 1994, American Express spun Lehman off as its own public company and handed the keys to a new kind of leader. His name was Dick Fold, a bond trader who had never known Lehman to lose. Under Fold, Lehman stopped playing it safe and started chasing scale. By 2007, revenue hit $19.3 billion, with over 28,600 employees across 40 countries. Lehman was no longer a cautious cotton trader's firm. It was the 4th largest investment bank on earth, and the very caution that had kept it alive for 58 years was about to be abandoned completely. 2007, Lehman Brothers posts the biggest profit in its 28-year history. $4.2 billion in net income, a record no one on the street can match. CEO Dick Fold is hailed as Wall Street's most respected banker, his firm untouchable. Beneath the champagne, Lehman is quietly becoming the most exposed bank in America. While rivals start retreating from mortgages, Lehman does the opposite. It accelerates. In 2007 alone, Lehman spends $22 billion buying Ardstone Smith, one of the largest real estate deals in history. The timing could not be worse. The housing market has already begun to crack. Internally, risk managers warn the firm is dangerously over-leveraged. For every one of real capital, Lehman is borrowing 31 to bet with. One bad swing, and there is no cushion left to absorb the fall. Executives who raise alarms are sidelined, reassigned, or pushed out. Fold's answer to a market smelling of smoke is to buy more matches. The firm that survived the Civil War, 2 World Wars, and the Great Depression now believes its own legend. But legends don't hedge risk, balance sheets do. And Lehman's balance sheet was about to be tested by a storm it helped create. 2007, Wall Street's biggest banks started quietly retreating from subprime mortgages. Bear Stearns pulled back. Merrill Lynch pulled back. Lehman Brothers did the opposite. CEO Richard Fold called it leaning in to a crisis he believed was temporary. In 2007 alone, Lehman poured billions deeper into commercial real estate and subprime assets. Everyone else was fleeing. By early 2008, Lehman's real estate holdings had ballooned past $110 billion. That's roughly triple its entire shareholder equity. Internally, risk managers raised alarms. They were overruled or sidelined. Fold's logic: Lehman survived the 1998 crisis, the dot-com crash, 9/11. This was just one more storm to out-tough. But this time the asset itself was rotting from the inside. Home prices were falling in more U.S. cities than at any point since the Great Depression. Lehman didn't hedge against that collapse. It bought more of it. By March 2008, Bear Stearns had already collapsed into a fire sale acquisition by J.P. Morgan. Lehman's own stock cratered 48% in a single week that month. Fold called it irrational market panic, not a warning. He was certain Lehman was different. He was about to find out how wrong that certainty was. The leverage ratio was a 5-alarm fire, so Lehman did something almost unthinkable. They called it Repo 105, a transaction that let them temporarily erase debt from the books. Every quarter, right before reporting day, Lehman shipped up to $50 billion in troubled assets off its balance sheet. Days later, the money came back, the assets returned, and the books looked clean again. Regulators saw a healthy bank. Investors saw a healthy bank. Neither saw the truth. This wasn't a rounding error. Auditors later called it balance sheet window dressing, and Lehman's own lawyers refused to bless it under U.S. law. So Lehman routed the deals through a London subsidiary, under British accounting rules that allowed the sleight of hand. For nearly 3 years, the trick worked, masking a leverage problem that should have terrified everyone. The firm wasn't fixing the sinking ship. It was just hiding the water. And the moment the tide caught up, there would be no accounting trick left to save it. The largest bankruptcy filing in American history happened at 1:45 a.m. on September 15, 2008. Lehman Brothers listed $609 billion in assets, more than the GDP of most nations. Richard Fold had spent the weekend begging for a buyer, a bailout, anything. The Federal Reserve said no. By Monday, the Dow Jones had plunged 504 points, the worst single-day drop since 9/11. Lehman's stock, once worth 86 a share, closed that week at 21 cents. Barclays bought the crown jewels, the North American Investment Bank, for just $1.75 billion. A firm that survived the Civil War, 2 World Wars, and the Great Depression didn't survive its own bet on subprime mortgages. 25,000 employees walked out with boxes that morning, live on every news channel in the world. Credit markets froze overnight. Within weeks, Congress approved a $700 billion bailout to stop the next Lehman from happening. Here's the twist. The history books gloss over. Lehman wasn't reckless because it misunderstood the risk. It was reckless because it believed it was smarter than the risk, smart enough to hold the bag longer than everyone else and still walk away clean. It didn't. The lesson isn't complicated. The strategy that made you rich can be the exact strategy that kills you. And the moment you think you're too clever to get caught is the moment you already have been. What if Lehman had raised capital in 2007, like its rivals did, instead of doubling down? We'll never know. Because by the time they asked the question, it was already too late.